which has meant that Holden has to supply now navigators at no extra cost. And the price of that Holden, I think, is basically what I paid for it back in 2010. It hasn't really changed much. So where's all this going? The point is that, yes, health and education, they've been going up in costs, but lots of other things that depend on technological innovation, they've been coming down in cost and getting cheaper. And so you end up with a very low inflation world. So when you look at that, those return charts and you say, well, I'm not getting 14% like I used to in the 1980s out of my balance fund, you may get it 1 year or another, and it goes up and down, but it sort of put an average through it. I'm not getting 14% anymore, I'm getting a much lower number on average. Just allow for that inflation is a lot lower today, and therefore you don't need as high a return as you would have had back then. So what I'll talk about is a bunch of things today. Some of these charts you would have seen a year ago, so I'll be updating them. Some of them are new, and of course there's a few more issues that have come along in the last year or so. And some of the things I'll talk about obviously are going to be about the shorter term rather than the longer term trend. So hopefully I can get this to move. I have. It's always a challenge to make sure you've got the technology right, pushing the arrows in the right direction. So that's a summary of how I see things. I would have said a year ago that the global economy will continue to muddle along. And I think that's what we're seeing. It's muddling along. So if we think about the last little while or so, there's been lots of things to worry about, and I thought I'd write them all down. That's the last 3 years. So at any point in time over the last 3 years, you could have got worried about the Fed tapering, remember all the taper talk, because when they were ending quantitative easing, America hasn't been printing money for quite a while now. Worries about Ukraine, I won't go through everything here. Ebola was a big fear a couple of years ago when it seemed to be out of control in Africa and everyone was worrying about it coming to Australia. Worries about Greece, last year, Brexit, everyone talking about Brexit. Worries about China, Brazil and Russia in recession, manufacturing slump, Trump, I suppose you can still worry about Mr. Trump. Worries about the Fed raising interest rates, Brexit. That was a funny day. If you think back through your life and you think of some days where you wasted a lot of time, well, that was one of those days. So the Brexit vote was on June the 23rd, but of course we found out the results through the day on June the 24th. So about 2 p.m, the BBC, in fact the same commentator on BBC who was there back when they had the referendum on whether they joined the European Economic Community back in the 1970s was doing it again this time. And so through the course of that day, you found out the results. And of course, the general conclusion, not from me, but everyone else, seemed to be that the sky was about to fall, that we will face ruin. And of course, Australian share market fell 3.5% that day. The Sydney Morning Herald and Canberra Times and everyone else ran their favourite headline, $60 billion wiped off the share market. It's funny, if I take all those headlines, 20 billion wiped off, 60 billion wiped off, 50 billion wiped off, we shouldn't have any money in the share market anymore. It would have been wiped off because they never tell you when the money gets put back, which it has been since then. But in any case, a lot of doom and gloom. Markets came down for another day on the Monday, so that was on Friday afternoon. Monday they came down again, and of course ever since then it's been forgotten about. It was another one of those interesting events. Obviously a big event if you're in the UK, but if you're in Australia, it's about as relevant as what was going on in Greece, or what was going on in any other part of the world. It's not a shattering thing. So I think that was exaggerating the importance of that. Then, of course, since then we've had a messy Australian election results. We've had South China Sea tensions. We've had an attempted coup in Turkey. We've had the Nice terrorist attack, and so on and so forth. So lots of stuff going on. That's 3 years. That's a list from the last 3 years. And yet global growth has continued. It's been muddling along at around about 3%. So if I go back to my summary there, I think that will probably continue. The world is not falling apart. We're not going to see another GFC, but by the same token, we're not going to boom either. What about Australia? So I've shown there some numbers for all the countries around the world, but Australia, I think, has been a big surprise over the last year. If I go back 4 years ago when the mining investment boom ended, we were told by lots of foreign commentators that Australia was stuffed. We were a one-trick pony. All we can do is mining, and of course the mining boom is long gone. It has certainly been a dampener on parts of the economy. If you're in Perth, you're not feeling very very happy. WA is not feeling very happy at the moment. But you have seen other parts of the economy spring back and fill the gap. We have not had a recession. In fact, the last recession was 25 years ago. So to me, that's one of the biggest surprises, how well the Australian economy has held up. In fact, for the year to the March quarter, it grew 3.1%, which may not sound that exciting. For an economy as well developed as Australia, to expand in size by 3% is actually quite a good thing. No other major advanced developed country has been growing at anywhere near that rate, including the US, Europe and Japan. What about interest rates? I know that's a fairly depressing story, and my mother gets depressed every time she hears this one. She asked me the other day again, she said, surely you don't think they're going to come down again? I said, well, they could. And obviously she's not happy because she's got some money in term deposits or bank deposits. I don't mind because I've got a mortgage still, and so lower interest rates are good for me, but not so good for her. But I think interest rates could still come down again. It's not something I have a strong view on, but I think they could still come down again in Australia. But the bottom line is, you're not going to see rate hikes for some time. The only country that may see a rate hike this year is the United States, maybe in December. What about the Australian dollar? I still think it could go down. I would have said this a year ago. Still more downside on the Aussie dollar. So if you think you'd go on an overseas holiday, you can get 77, 76 US cents for one Aussie dollar. It's not a bad time to book in for that. But bear in mind, we've come from $1.10. We've already had a big fall. So it gets a bit more difficult for me, forecasting that last little bit on the Aussie dollar. But I think the risk is still on the downside. What about share markets? Horrible period. Almost from when I was here last year. Well, it started, the rocks seemed to set in about April, particularly through June and July. So in April, the Aussie share market got up to almost 6,000 on the index, and then it had a fall through June and July, and then it had a fall around August last year, and then it had a sharp fall, very sharp fall in January and February this year. In fact, for me, this wasn't a great start for the year because several things were going on. One is my wife wanted to do some renovations on the house. I was quite happy as it is, even though things were round the wrong way. And she was getting annoyed with me for not fixing things up in the house. So I finally agreed we'll do some renovations, but to do the renovations, the builder said it'll only take a few months if you move out. So you can understand this, moving out of a house after many, many years is quite traumatic. I'm told it's one of the most traumatic things in your life. And of course, always they say, well, it takes a few months, and we moved back in 3 months ago, and they're still going around us. So it always takes longer than you think. So that was the first thing that happened. Then, of course, I was out on the boat one day. I got this little tinny, and I think my daughter was driving it, and I was being pulled along behind on this little tinny on a tube, like those things that set resorts, but a mini version. And the trick was to always knock everyone else off, but of course I got knocked off. And my leg went one way, I went the other, I ended up with a torn hamstring muscle, so I was limping around. And around that same time, the share market started falling, particularly starting with the Chinese share market and our share market. So when we get to the low point in February of this year, the Aussie share market has had a 20% fall from its high in April last year to the low in February. And I'm feeling kind of depressed, I'm missing the house and all this sort of stuff. It's funny when you go to a new place, I didn't quite have all the gadgets that I had, but we managed to get YouTube operating on this Apple TV I plugged in. And I've always had this, I like lots of music. One of the things that you need in your mind to sort of turn down the noise, because a lot of the noise is depressing, from the news, for example, is you listen to music. And I've always liked this singer from the 1960s called Claudine Lauget. Claudine Lauget was in this film that Peter Sellers made called The Party in 1968. She played the singer, saying Nothing to Lose, and we don't remember all that. But I was YouTubing Claudine Lauget. Turns out she was married to Andy Williams. And I thought Andy Williams was this old-fashioned crooner. And I discovered, he probably is, he probably is. But anyway, I discovered he had this really great voice. And I discovered that every year, through the 60s, into the 70s, he would record a couple of albums, usually covering top hits of the day, Elton John, Beatles and what have you. And I got in my first one, which
had all these Elton John songs on there, the Partridge Family was covered and so on and so forth. I thought this is fantastic stuff. In the end, I ended up with every Andy Williams CD, because I still like CDs, I can put them in the CD player in the car, from Andy Williams from about 1968 up to about 1974. And at one stage, my daughter got in the car and said, "Can we listen to somebody else now? I've had enough of Andy Williams." And I said, "Well, unfortunately, I've got rid of everyone else. No more Taylor Swift, no more Katy Perry, they're all gone." In any case, I've sort of weaned myself off Andy Williams a little bit. But if you want to hear a good singer, he does have a good voice. He passed away, unfortunately, in about 2012. So anyway, fairly rough start to the year. I smoothed it over with a bit of Andy Williams music on the way. But share markets, pretty rough time into January, February. Since then, we've seen a good recovery in markets. But we're also back in August. And if you look historically at markets, this period from August, September, October can often be fairly rough in share markets. You can't recall 1929, but the 1929 crash occurred in October, I think it was 1929. The Aussie share market crash of 1987, it was in October of 1987. Lehman Brothers, September of 2008. Last year, the rough patch through the September quarter. So we're coming to a rough period. Now, I don't anticipate big falls, but I do think we've gone up a long way in the very short term. So we could go through a bit of a consolidation, a bit of volatility in the short term, and then I see a rally into year end because the overall environment globally, I think, is okay. What do you keep an eye on? You keep an eye on what the Fed's going to do. That's the US Central Bank when they raise interest rates. You keep an eye on China. You keep an eye on Europe. There's always issues in Europe. The next one coming up will be an Italian referendum on their Senate. So if you think about Italy, the last, as long as I can recall, they've been ungovernable because whoever controlled the lower house has not had control of the upper house, their Senate. Reminds you of some other country. Very close to us. And so anyway, Matteo Renzi, he's their current Prime Minister, he has put up a referendum to reduce the power of the Senate. And if it's not passed, then he's threatened to resign. So we could go back to the revolving door leadership of Italy. So there's a bit of an issue around that one. And obviously Australia post the mining boom, messy election was. So there's things to keep an eye on there, but I think ultimately we'll probably be okay. So that's the worry list, lots of things going on. What have returns been like? I think Russell sort of alluded to that. In the last few years, it's been a bit rough, but there's been some good return years in there. Haven't been too bad. Around 2012, 2013, you've got good returns. So even though it's been volatile the last 10 years, and on average it's been lower in terms of returns, there has been some good return years in there. And it's worth thinking about the last 3 years. That worry list was what's happened in the last 3 years. Lots of things to worry about. But interestingly, returns have been okay. So what I've shown there is the annual returns from the major asset classes for 2014-15 in green and 2015-16 in blue. But the key point is up the top there, that over the last 3 years, an average superannuation fund after tax and after fees has returned about 8% per annum. So not too bad in the great scheme of things, despite that worry list. So we hear a lot about global growth, so I want to go through that muddle through bit, just a bit quickly. Every so often there's an organisation out there called the International Monetary Fund, and they say they've yet again revised down their growth forecasts. And we all go, shock, horror, it's all horrible, isn't it? Just bear in mind that every year they start off forecasting 4% global growth, and then as the year goes by, they revise it down to around 3%. So the world will still grow, it's not collapsing, it's just they keep starting off with a new year when they're talking about those downwards revisions. But if we see growth hovering, oops, not a bit too far there, try to hit the light, miss that one. But if we see growth averaging around 3%, I think that's okay for the global economy. Not as good as it used to be, but it's sort of okay. So, is there any evidence to suggest that global growth will be okay? So I want to put these ones up a year ago. So there's organisations that survey businesses around the world, and they ask them, how do they feel? How do those businesses feel, happy or sad? And they call those surveys these days Purchasing Managers Indexes, or PMIs. They're basically a guide to business conditions or business confidence. And you can see when you look at organisations around the world for the last decade or so, they're not as happy as they used to be prior to the GFC, but they're not as sad as they were through the GFC either. They're sort of around average, depending on whether you're in a developed economy or emerging market, or you're in services or manufacturing. They're around average. They're sort of okay, which tells me things aren't that bad globally. And then the big thing I think you need to be aware of is this. This is kind of a bit technical, but I might show this one, which you can't read at all. This is one of those charts you put up to show you've done some work. So earlier this year, we had the Aussie share market fall 20% from its high in April last year to its low in February this year. So some people call that a bear market. You know, bull market, bear market. That was a bear market, 20% or greater fall. And to me, the relevant question is not so much that it's come down, where will it be in 12 months' time? Will it keep going down, or will it gradually recover? And I'll look back through history. If we go back to 1900, I've shown there all of the bear markets, that's 20% or greater falls in the Australian share market from 1900. If we go back to 1900, there's 17 bear markets, excluding the one we saw earlier this year. 17 bear markets back to 1900. And I've shown all the dates, all the dates there. My favourite or worst one was the 73, 74 one. That's when my hero Elvis started to put on weight and apparently left the building. I'm still debating that one. And of course, my favourite TV show, The Brady Bunch got canned, so I couldn't sit there and be amazed at how pretty Marshall was. David I was 13, 14 back then. This is not Rolf Harris. This is a very different story. So anyway, those two things happened, and people got very depressed as a result of that. Now, of course, my father, he would say there was lots of other things going on back in the 1970s. We had OPEC, we had the disaster because of Vietnam, we had Whitlam in Australia, who did lots of good things, I think, but also it wasn't so good from an economic point of view. It might be a disaster from an economic point of view. So it wasn't a flash time, and the share market fell 59% from its January 73 high. It was when Elvis appeared via satellite in black and white for us from Hawaii. September 74 when the Brady Bunch got capped, down 59%. Horrible time. So there are all the bear markets back to 1900. The question I have is what happens after that initial 20% fall, which we've seen. We've seen a 20% decline to the lows in February. Where are they 12 months' time? Now you find if you go back through history, there's two types of bear markets. Credit Suisse sort of called them grizzly bears. That's where the market comes down 20%, and a year later it's down even more, down another 20% or so. Obviously, in the 1970s, obviously the GFC, they were grizzly bears. If you go back through time, there's been 6. Got this right? That's the red ones there. 1, 2, 3, 4, 5, 6. 6 grizzly bear markets. That's where you come down 20%. A year later, you're even lower. Alternatively, there's a gummy bear market. So a gummy bear is like these lollies here, you know, when you put it in your mouth, it tastes nice. And so they're not so bad. So you come down 20%, a year later you're actually up. And if you go back through time, there's 11 gummy bear markets. This is very important. I think, what the hell is all this rubbish going on about? There's 11 gummy bear markets back to 1900. Now the big difference between the two is whether you have a recession or not. So I've shown there in that column of numbers there whether there was a recession or not. And it tends to be the case that the really severe bear markets, grizzly bear markets, you have a recession in Australia or the US. Whereas gummy bear markets sometimes have a recession, but most of the times they don't. So to me that's the big issue here. If you've got money in the share market, if you believe we're going to have a recession or America is going to have a recession, then head for the hills with a can of baked beans and a gun. Or if you don't believe that, then you might as well leave your investment in the share market because it's probably continuing to recover. So that's quite important, which is what I'm trying to show with that table there, and I'm sure if you want copies of these charts, you can get from Russell afterwards. And that's another way of showing it there. The bear market declines in blue through there, and you can see that on 11 occasions, after initially falling 20%, a year later you're actually up. And the key decider is whether you have a recession or not. If we don't have a recession, 12 months' time, the Aussie share market's probably going to be higher. So that's very important, I think. Let's look at the US first. Are they going to have a recession? I don't think so. I know there's lots of talk about America having a recession, but I don't see the normal things that precede American recessions. I don't see high inflation. I don't see the Fed aggressively as their central bank. I don't see aggressive interest rate hikes from the US Federal Reserve. I don't see an over-investment in technology like we had prior to the tech wreck. I don't see an excessive level of investment in housing activity. So that's housing investment in the US as a share of overall economic activity. So a lot of the things that we normally look at to say there's going to be a recession here, they aren't there. So I'm not that worried about the US. And most of the economic data coming out of America looks okay to me. Unemployment, so the red line there is the US unemployment rate, it's collapsed. Even if you add in underemployment, this is where you ask people, do you have a job, you want to work more hours? Even underemployment in America has collapsed. It was 20%, now it's about 10%. So whichever way you look at it, America looks stronger. Confidence is up. Investment is up. I was in America actually 6 months before I was last down here in Canberra, and I got to say it looked pretty good compared to say 5 years ago. So I think the American economy looks okay to me. What about this guy? This guy got me worrying. I initially sort of laugh at him. He makes comments like that one there. It's very hard for them to attack me on looks because I was so good looking. That was August 7th, 2015. I must admit, the more I hear about this guy, the more I don't like him. I've got to be careful because I'm sure someone secretly likes Donald Trump. The thing that worries me a little bit is that he seems to be very narcissistic and driven by his ego. So whenever anyone attacks him, he makes a big thing out of it and gets into these stupid fights with people. And I don't think that's a trait that a US president should have, because he will have his finger on the button of nuclear weapons, and I don't think that's a healthy thing to happen. The other reason I don't like him is he's not a good role model. So if my son said that women were pigs, that Hispanics were rapists, and the things that he said about Chinese, then my son will probably not be welcome in my house until he apologises and says he'll never say these things again. That's not the sort of behaviour that I expect from people, certainly not from a president of the United States of America. So fingers crossed he won't be. I think the Republican Party is a great party in the US. Reagan is someone, I hated Reagan at the time, you know, I was more left-wing back then, but no, I think Reagan did some good things for the US, but I think at the end of the day, this guy should not have got the nomination. Anyway, that's just my personal view. I can understand why there's an interest in Trump. Why is there an interest in Trump? Why was there a Brexit vote? Because we've had a lot of globalisation and inequality levels have gone up. I think there is an issue with inequality in the US. I think there's a serious issue there that someone will have to address. And a lot of people feel they've been left behind after the development of the last 30 years. So that to me is the big issue here, but I don't think Trump is the guy to fix it. All the evidence suggests that he's a very bad businessman. So I don't think he's the guy who can fix this problem. Anyway, time will tell. Hopefully he won't be president. If he is president, there's two ways to look at this. On the one hand, there's lots of negatives there, some of them I've gone through. On the other hand, he's also saying he's going to spend more on infrastructure. And you could argue, well, if there's more government spending on infrastructure, that might turn out to be a short-term good thing for the US economy. Longer term, though, I would be a bit concerned about things if he does take over. Hopefully, that won't happen, and the other side gets the gig. What about Europe? I think that Europe looks okay. I've shown there since the year 2000, GDP growth in red. That's the GFC there. And I've shown a measure of manufacturing conditions or confidence in blue, and it's sort of hanging around okay levels. You know, got up this morning. One of the first things I do these days after having a shower is turn on my little iPad, see what the economic data did overnight, and I looked at the latest update for what they call their confidence readings in Europe, and they've held up. So we've had 2 months after Brexit, and businesses in Europe are feeling reasonably happy about things. Not fantastic, not booming, but certainly not falling apart. So I think Europe looks okay. Obviously, a lot of doom and gloom after the Brexit vote, but a bunch of things to bear in mind. Firstly, it's probably going to be a bit rough for the UK economy. I don't know which way they'll ultimately go, but probably rough for them. But they're only 2.5% of world economic activity. They only take 2.7% of our exports. So the UK, I know we hear about them all the time because we get BBC feeds into our TV stations and radio stations, but just got to put this in context. Europe is far more significant to the global economy, to our economy, than the UK is. So even if the UK has a recession, the real issue is what happens to the rest of Europe. And the rest of Europe, the issue there is whether Europeans think, well, they've had a vote to leave, why can't we do the same thing? So that's a thing to keep an eye on. My feeling, though, is ultimately the rest of Europe will hang in there. Why do I say that? Because I've seen survey after survey where Europeans say, why are you in the European Union? Oh, we're in there because it feels stronger. Whereas the UK has never felt that need because the UK sees itself as a military power in its own right. Why is Sweden there? Why is Denmark and these other countries in there? Because they feel that they're stronger as part of a broader Europe, and they're all aware of the political history in Europe, where they go through war after war up until World War II. So my feeling is they'll probably hang in there. I think you've probably got to keep an eye on Spain and Italy. Good news is, go back to the Eurozone crisis back in 2011-12, which I'm sure Russell would have covered at that time with you. You saw a huge increase in bond yields in those countries. People said, well, if I'm going to lend money to Spain or to Italy, I want a higher rate of interest because I don't know whether I'm going to get paid back in euros or depreciated liras or pesetas, I think the Spanish currency was called. Whereas now, the bond yields in those countries are very, very low. So I don't see the sort of crisis anywhere near, anything near the sort of crisis we had back at the time of the Eurozone problems a few years ago. So I think Europe probably looks okay. Chinese story, again, similar story. Lots of worries about China. Chinese growth has slowed down. You can't grow 10% forever. One big thing to note is that the most important sector in China today is no longer manufacturing, it's the services industry. And I think a lot of people have missed that. And so if you're thinking of Australian companies that have exposure to China, maybe you should look more favourably on those companies that have an exposure to the Chinese services sector that will benefit from Chinese tourists coming to Australia, or will benefit from growth in the Chinese financial sector as opposed to just the miners. So China is rapidly changing. In fact, ever since 2012, the services sector has been a more significant part of China's economy than manufacturing. So yes, manufacturing has slowed a bit in China, but the real story is growth in services. So what about the world economy? Very low interest rates. I think Russell's done a great job of explaining part of that. Very low inflation. So when you've got very low inflation, what do? You're going to have very low interest rates to go with that. Australia and China are the aberrations there a little bit, but as you can see, interest rates in China and Australia is that black line through there. Interest rates in those countries have been coming down as well. And as I mentioned earlier, I think there's still a chance that our interest rates might go down a little bit further. So what about the Australian economy? So we're now 1 year on from when I was last year. A year ago I was feeling okay about Australia. I thought they might have to cut interest rates again. They did. Rates were cut in May this year and early this month. But several things worth knowing. So first thing is that we had the biggest boom in our history. Mining investment, that's the red line through there, surged. And that was all very nice. If you're a mining investment company or a mining company or a worker that benefits from that. But if you're in Canberra, if you're in Sydney, it's not such a good thing because you had high interest rates, you had a high Australian dollar, the tourists weren't coming, manufacturing was closing down and so on. So anyway, mining investment peaked, as we all know, and it's in the process of collapsing. But the good news is we're getting close to the bottom. It's not going to go much lower. So I reckon in a year's time, the collapse in mining investment will have run its course. In the meantime, we've seen a surge in housing investment. which is still helping the economy. Retail sales have sort of been okay. The really amazing stories are these two. Our third biggest export earner is education. So you've got iron ore, you've got coal, and you've got education. It was flattened a few years ago. In fact, it was going backwards because the students weren't coming anymore to ANU or whatever because it was cheaper to go to Canada or somewhere else. Now they're coming back again, so education export earnings have gone through the roof. Tourists are coming back again, tourist export earnings coming back again. So the story on Australia, I think, looks reasonably good. And also, I think I would have had this chart a year ago, if I do a ranking of how the states are going, a year ago, or 10 years ago rather, the best states were WA and Northern Territory and parts of Queensland. Now it's totally reversed. So when you look at things like retail sales, building approvals, home prices, employment and so on, the top ranking state is Victoria, the second ranking state is New South Wales, and the third ranking state or territory is the ACT. WA is the worst performing state, ranked number 8. So when you go to WA and things are kind of depressed and they say they're not very happy, just put it all in context. Other parts of Australia have filled the gap, which I think is a very positive thing. So the doom and gloom you've heard about Australia hasn't really come to pass. The Australian economy has kept growing because those other parts of Australia have helped fill the gap. So very important. So why is the Reserve Bank cutting interest rates? Quite simple. They target an inflation rate of 2 to 3%, and recently the inflation rate has fallen well below that. And they worry that if they let it stay down for too long, we might tip over into absolute deflation in the economy, like Japan's had over the last few years. So they've been trying to get that inflation rate back up. Maybe that will happen sometime in the next couple of years, inflation will stay back up, but that's largely why they cut interest rates. Another factor, of course, was that America has close to zero interest rates, so does Europe and Japan, and therefore there's not much incentive to park your money in those countries. But Australia has had 2% interest rates, so there was more incentive to park your money in Australia. And that pushed the value of the Aussie dollar up at a time when the Reserve Bank wanted a lower Australian dollar. So another reason they've been cutting is to make it less attractive to keep money in Australia and therefore hopefully push the Aussie dollar down, because when you have a lower Aussie dollar, it makes it more attractive for students to come to our universities, for tourists to come to Australia, for Australians to holiday in Australia rather than go to LA or wherever, and that helps rebalance the economy. So anyway, as I mentioned, there's still a chance the Reserve Bank might cut again. What about Australia's AAA credit rating? This one's a bit of a comedy. Every time we get to the budget, this is whether we don't come down here in May, we're all about the budget. And this year's budget was a kind of interesting one with all the changes on superannuation, which can be kind of depressing if you think you've done the right thing and something's all changed on you just before you retire or when you're in retirement. A lot of debate about that, but of course economists like to focus on the budget deficit when we're eventually going to get back to balance. So what I've shown there is the budget balance, whether we're in deficit, which is down here, or surplus up here, and I've shown it as a share of GDP. So as you're well aware, in the 1980s, in the 1990s, we had budget deficits, except for a brief period around the late 1980s. And then, of course, more recently, we've gone back into budget deficit. So our level of public debt is going up again. And recently, we were told by one of the ratings agencies who put a credit rating on our debt, Standard & Poor's, they said we've now got a negative outlook. And that's all a bit worrying, because the last time we had our credit rating downgraded from AAA to the next one below was by Moody's. It's another ratings agency, and that was back in 1986. So where is that? 1986, just there. We went from, 1988, I've got the date. So we went from AAA in September 86, just after Paul Kenny's Banana Republic speech, to AA1. Now, obviously, there's a concern that we might get downgraded again, because we don't seem to be able to get our budget deficit under control. I think there's another attempt at the moment to get some rules passed through Parliament, but time will tell whether they'll cooperate on all that or not. There is an issue about this. Would it be the end of the world if it went downgraded? Well, in some ways, no. We'd probably still end up paying the same rate of interest if you got a mortgage. I don't think it would change much. On the other hand, it would probably be a bit of a psychological blow, because it's a sort of a bit of a cross against Australia. We're not as good as we once thought we were. So there are some issues around that, and hopefully we will maintain that AAA credit rating going forward. Now, I want to talk about something, just intermission, if you want to call it intermission, for a couple of moments, and that is living longer. There's lots of things you can do to live longer. One of them seems to be have 2 drinks a day. So often when I do presentations, there's another speaker. Today it was Russell himself. And on occasions in the past, there's been a doctor presenting with me, a medical doctor, and he was one guy called Dr. John, and he had a chart that looked a bit like that. Now, of course, I didn't think at the time to get the chart. But what it shows is the optimal number of drinks per day. So, there you've got the death rate, high, you died earlier, low there, and this is the number of drinks per day, 0 to 6. And what you find is that the risk of dying is the same for a teetotaler as it is for someone who drinks 6 a day. Because if you imagine, there's 2 lines there. There's one line which starts off when you're at 0, you've got lower risk of cancer but higher risk of heart disease, drinking 0 a day. And as you drink more, your risk of heart disease goes down. Okay? But once you go past about 2 or 3 a day, your risk of heart disease goes up. Sorry, your risk of cancer goes up. Until you get back to 6, and beyond 6, you're drinking too much. So 2 is the optimal number. Apparently, anyway. For a female, out of interest, I should qualify. I've already had my 1 today. That's why I grabbed that one when I came in here. For a female, it's slightly less than 2. You know, some say it's about 1 is the optimal number of drinks for a female a day. I then thought I'd look around the world and see what other countries say on this. And this shows the definition of a standard drink. In Australia, 1 standard drink is defined as 10 grams of pure, 10 grams of pure alcohol a day, just there. And in Australia, the recommended guideline for males and females is 2 standard drinks a day. So it's precisely in line with that chart there. There's the 2. Surprise, surprise. So Dr. John was quite useful in that regard. And I got this from a group called the Society for the Study of Addiction. Well, actually, I did what Russell did. I saw it in the Economist magazine. I scanned it up there. Anyway, they measure this sort of stuff. And the funny thing is, if you want to drink more drinks a day and feel comfortable and be consistent with the national guidelines, you just move to the US, where the recommended daily guideline is 4. Just over 4 drinks a day for females and over 5 drinks a day for males. So that's if you want to feel comfortable drinking more drinks. Anyway, enough on drinks. A couple of other things. I've also seen 2 other studies in the last week quite useful. If you're into longevity, the first one is that you can extend your life by 23 months, almost 2 years, by reading a book for half an hour a day. And apparently it doesn't apply to reading a newspaper. You need stuff that really entertains the brain. So I actually do that. Every night I sit down and before I go to sleep, and I read fantasy novels because they entertain the brain. So hopefully I'm extending my life by 23 months. The other thing I found was that patient people make better investors and live longer. So patient people are more likely to hang in there with your strategy rather than tip out every time there's an upset. And as I've shown in that long list there's lots of upsets along the way. And they're also more likely to keep appointments with their doctor on a regular basis, when you go down for a checkup once a year. So the doctor finds problems earlier and the person lives longer. So anyway, just remember those two things. 2 drinks a day for a male, 1 drink for female. And I should say red is better than white, is better than beer, is better than spirits. So it should be those top lines. You want the antioxidants from those sorts of alcohol. Half an hour a day reading of a book
A lot of debate here whether it should be hardcover, softcover, Kindle, does that work? The danger I always find with hardcover books is that when I nod off, you know, you're in your bed reading, A, it's harder to keep a hardcover up there, and B, when you nod off, it really hurts when it falls on your head. Almost knocks me out. And the other one, of course, is try and be patient. You know, try and be patient. That's why they often say try and invest for the long term rather than the short term. In any case, enough on that. What about the share market? A lot of impatience in the share market. This is a cartoon I saw many, many years ago. Someone says, I've got a stock here that can really excel. Excel. Next thing, someone interprets that as sell, or panic. Someone says, I've had enough of this, get me out of here, I can't take it anymore. Goodbye, buy, they're all buying again. And to some degree that reminds me of the way the share market's gone in the last year. Why have people been worried about the share market? There's been worries about the emerging world, worries about China, worries about the impact of low oil prices. Now when petrol prices go down and I go into the service station, fill up the Holman Caprice, it takes 75 litres, never gets that low, but say you put in 65, I was paying over $100 for a while there. Lately I've been paying, I can't work out what it is, 60, 50, those sorts of numbers. I've been so excited